In 1944, the United States hosted representatives from 44 allied nations at a resort in Bretton Woods, New Hampshire, and established the architecture of the post-war global economy. The dollar would be the world's reserve currency. Every other currency would be pegged to the dollar, and the dollar would be backed by gold. 80 years later, the dollar is still the world's reserve currency, but its share of global foreign exchange reserves has fallen from 85% in the 1970s to 57% in 2024, the lowest level in 25 years. Nobody announced this, no international body voted on it, no single country declared that it was reducing dollar exposure. The shift happened transaction by transaction, reserve decision by reserve decision, trade deal by trade deal, quietly, gradually, and then increasingly fast. This is the story of how China built the infrastructure to replace the dollar, not in a single dramatic moment, but through a decade of systematic construction that most of the world barely noticed until it was already operational. To understand what China is building, you have to understand what the dollar's reserve status actually gives the United States, and why losing it would be the most consequential economic shift in a century. When the dollar is the world's reserve currency, every country on earth needs to hold dollars to participate in global trade. Oil is priced in dollars, major commodities are priced in dollars, international debt is denominated in dollars. To import goods, service debt, or maintain financial stability, countries must hold dollar reserves, which means they must continuously buy American currency and American government bonds. The economist Valéry Giscard d'Estaing, who later became president of France, called this America's exorbitant privilege. The United States can run trade deficits, print money, and accumulate debt at a scale no other country could sustain because the rest of the world has to absorb those dollars. The US national debt currently stands at $34 trillion and grows by approximately $1.8 trillion per year. That is only sustainable as long as the world needs dollars badly enough to keep buying American government bonds. The moment dollar demand weakens, the moment other countries can conduct trade, hold reserves, and service debt in alternatives, the exorbitant privilege erodes, and with it the financial conditions that have allowed the United States to project global power for 80 years. The first pillar of China's dollar replacement architecture is a payment system most people have never heard of. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is the messaging network that connects over 11,000 financial institutions in more than 200 countries and processes the communications behind approximately $5 trillion in daily transactions. When the West cut Russia from SWIFT in 2022, it demonstrated that SWIFT access is a geopolitical weapon. Every non-Western country watched and drew the obvious conclusion: if it happened to Russia, it could happen to anyone. China had anticipated this vulnerability years earlier. In 2015, the People's Bank of China launched CIPS, the cross-border interbank payment system, as a yuan-denominated alternative to SWIFT for international settlements. By 2023, CIPS was processing $13 trillion in annual transactions across more than 100 countries. After Russia's SWIFT exclusion, CIPS sign-ups from non-Western financial institutions accelerated sharply because every bank in the Middle East, Southeast Asia, Africa, and Latin America began hedging against the possibility of finding themselves in Russia's position. CIPS is not yet a SWIFT replacement. Its transaction volumes are smaller, its network is less deep, and it primarily handles yuan-denominated trade rather than the full range of global currencies. But it doesn't need to replace SWIFT entirely to achieve its strategic purpose. It needs to be large enough that a country cut from SWIFT can still conduct meaningful international trade, and that threshold has already been crossed. The second pillar of China's strategy targets the most sensitive nerve in dollar dominance: oil pricing. As we covered in a previous video on the petrodollar, the 1974 secret agreement between the United States and Saudi Arabia established that all Saudi oil sales would be denominated in dollars, creating the structural demand for dollars that has underpinned reserve currency status for 50 years. The arrangement held without challenge for nearly half a century. In March 2023, Saudi Arabia agreed to accept Chinese yuan as payment for a portion of its oil sales to China. It was the first confirmed crack in the petrodollar system in 5 decades. Iraq announced it would settle some oil trade with China in yuan. The UAE began pricing certain energy transactions in yuan. Russia, which has been conducting the vast majority of its China trade in yuan since 2022, is now the largest single supplier of oil to China, all of it settled outside the dollar system. China had laid the groundwork for this years earlier. In 2018, the Shanghai International Energy Exchange launched yuan-denominated crude oil futures, the so-called petroyuan. At launch, analysts in Western financial media dismissed it as a minor curiosity. Within 5 years, the Shanghai crude futures contract had become the third most traded oil futures contract on Earth, behind only the Brent and WTI benchmarks traded in London and New York. China is the world's largest oil importer, having overtaken the United States in 2017. When the world's largest buyer of oil insists on paying in its own currency and builds the settlement infrastructure to make that possible, oil exporters accumulate yuan. Yuan they then need to spend somewhere, and China has built the answer to that question as well. The third pillar of China's strategy is political, the construction of an economic bloc large enough to conduct meaningful trade among its members without touching the dollar system at all. BRICS was formed in 2009 as a loose association of emerging economies, Brazil, Russia, India, China, and South Africa, representing a combined economic and demographic weight that dwarfed the original 5 members' political leverage. In 2024, BRICS formally expanded to include the United Arab Emirates, Saudi Arabia, Iran, Ethiopia, and Egypt, with dozens more countries on a waiting list. The expanded BRICS bloc represents 42% of the world's population and, measured by purchasing power parity, an economy larger than the G7 combined. It includes the world's largest oil exporters, Saudi Arabia, Russia, UAE, and Iran, and the world's largest oil importer, China. An energy market of that scale, conducted entirely in non-dollar currencies, does not need the petrodollar. BRICS members have not agreed on a single replacement currency. The discussions remain complicated by the political tensions among members. India and China share a contested border. Brazil and Russia have little in common, but the formal currency basket discussions are secondary to what is already happening at the bilateral level. India settling oil trade with Russia in rupees, Brazil settling trade with China in yuan and rias, Saudi Arabia accepting yuan for Chinese oil purchases. The dollar is not being replaced by a single alternative, it is being bypassed, transaction by transaction, by a growing number of bilateral arrangements that simply don't need it. The fourth and most technically sophisticated pillar of China's strategy is the one least understood in Western financial coverage, the digital yuan. China's ECNY, the digital yuan, is the world's most advanced central bank digital currency. Over 260 million Chinese citizens hold digital yuan wallets. But the domestic rollout is not the strategic point. The strategic point is what the digital yuan does when it connects to the international settlement infrastructure China has been building. In 2021, the Bank for International Settlements began running a project called mBridge, a multi-central bank digital currency platform involving the central banks of China, Hong Kong, the UAE, and Thailand. The purpose of mBridge is to allow central banks to settle cross-border transactions directly with each other in their own digital currencies, without routing through SWIFT, without correspondent banking relationships, and without touching the dollar system at all. If mBridge scales, and Saudi Arabia's central bank joined as an observer in 2023, the plumbing of international finance can be rebuilt from scratch on infrastructure that China controls, not the messaging layer like SWIFT, not just the currency like the yuan. The entire settlement architecture. Here is the part that Western governments will not say publicly. The single greatest driver of de-dollarization is not China's strategy, it is American sanctions policy. Every time the United States freezes a country's dollar reserves, excludes it from SWIFT, or imposes secondary sanctions that threaten third country banks, it sends an unambiguous signal to every other country on Earth: holding dollars is a geopolitical risk. Iran has been under comprehensive US sanctions for 40 years, Venezuela for over a decade, Cuba for 60 years, Russia since 2022. Each of those countries became a yuan customer by necessity, but the countries watching most carefully are not the sanctioned ones, they are the neutral ones. The Indias, the Saudi Arabias, the Brazils, the UAE, countries that have no current conflict with the United States but cannot be certain they never will. When the US froze $300 billion in Russian sovereign reserves in 2022, China's central bank reviewed its own dollar exposure and accelerated its diversification into gold. China has been purchasing gold at a rate of 50 or more tons per month and now holds over 2,200 tons in official reserves, with many analysts believing the true figure is significantly higher, held through intermediaries not reported in official statistics. The French Finance Minister Bruno Le Maire said publicly in 2023 that Europe must reduce its dependence on the dollar or face American extraterritorial legal jurisdiction over European companies forever. This was a European Union finance official, not a Chinese propagandist, describing dollar dominance as a problem for Western allies. Here is what the data actually shows. The dollar is not going to be replaced by the yuan. China's capital controls, its closed bond market, and its unwillingness to allow free convertibility of the yuan make it structurally unsuitable as a global reserve currency in the way the dollar functions today. What is happening instead is fragmentation. A portion of oil trade settled in yuan. Some central bank reserves held in gold instead of dollars. CIPS handling a growing share of transactions that used to run through SWIFT. The digital yuan bypassing correspondent banking in Southeast Asia and the Middle East. BRICS bilateral trade conducted in local currencies. No single piece of this is a replacement. Collectively, they represent the slow erosion of the structural demand for dollars that has underpinned American financial power since 1944. The United States borrows $1.8 trillion per year at rates the market will accept, partly because the world needs dollars. As the world needs dollars less, those rates will rise. The cost of maintaining American military and economic dominance will increase at exactly the moment that the revenue model funding that dominance begins to weaken. China does not need to win a financial war against the United States. It only needs to make the dollar slightly less essential in enough places for enough transactions that the math of American dominance slowly stops working. That process is already underway. And the most powerful country in the history of the world is watching it happen without a clear answer for how to stop it.